Good morning, everyone. We're just adding everybody to the meeting, so just give us just a minute while everybody jumps on. Okay, I think we've got the majority of everybody. So good morning. Thank you all for joining us. We're excited for the Private Investor Club to have this private webinar with our co-founders and our Chief Operating Officer. We will briefly touch on the fund. I've spoken with many of you. Some of you all are still contemplating your investment in the fund, but we thought it was important for you all to meet the sponsors. We wanted to hear from you all as well. Any direct questions for Fred, Dennis, or Andrew. I'm going to open up the Q&A. You'll see a box populate, and it'll be where you can answer, put in your questions, and then I'll moderate them at the end of the presentation. And I'm going to kick it off to Dennis Cisterna to open us up here and get started.
Great. Thanks, Laura. Thank you all for joining. I see there's still a lot of other people joining, so try to get those people in as quick as possible. Thanks for taking time today. So we're going to spend the next 30 to 45 minutes really going over, excuse me, over the fund's strategy, what we see as the market opportunity, and share a little bit about our background and experience as a sponsor. So with that, before I begin, just gotta give you a quick disclaimer that this is only for informational purposes only. This doesn't constitute an actual offer or invitation to subscribe with us in any capacity. And also, please recognize that this is a 506c offering, so this is limited to only accredited investors. All potential investors must be verified through a third party or other methods, as we will detail with you at the end of the webinar. Okay, now that I got that out of the way, we're going to jump right into it. For those of you who don't know who we are, Sentinel Lease is a privately held real estate investment firm. We were founded in 2019 by myself. I'm Dennis Cisterna. I'm our Chief Investment Officer, and my fellow co-founder, Fred Lewis, who serves as our CEO. Joining us also is Andrew Brorin, who's been with us since inception and is our Chief Operating Officer. Since starting in late 2019, we've acquired over 300 million assets. $300 million in assets. We've sold off a couple properties. Our current portfolio of stabilized assets, 16 assets, 17 if you include a value add property we can talk about, and totals about 1.6 million square feet across 12 states. We have done phenomenally well relative to the market. Our average annual cash on cash return net to our investors from lease income alone averages almost 12%. And we have completed 2 deals that have yielded a net IRR on average of 37% to our investors. Because we are investing in primarily net lease properties, the cash flow is predictable. Can't say that for a lot of other asset classes right now. And because of that, our actual cash on cash versus what we've projected is actually 99%. So on the whole, we are doing exactly what we thought we would be doing from a performance perspective, and actually exceeding it when it comes to round trip investments. Okay, so before we get into the fund itself, I just want to spend a few minutes talking about what we see as the current market opportunity. Even though Sentinel has been investing in commercial real estate for the last 5 years, we think we're in a very unique time in the market right now that is going to provide some great risk-adjusted returns, especially relative to other asset classes. So if a lot of this information looks familiar, it is from the investment summary, but it's always great to add additional context to what our thoughts are on why we're doing what we're doing. So obviously with the Fed raising interest rates as much as they have, or at least the key indices behind them, the federal funds rate, it has made borrowing extremely expensive for all types of borrowers, and no one's getting hit harder than that than commercial real estate investors. And so you can see here that the federal funds rate now sitting at 5.3%, the 5 and 10-year treasury at roughly 4.5%. Those are the primary indices for fixed rate commercial real estate debt. And so what's happening right now is basically the bigger universe of commercial real estate, instead of borrowing at 3 to 4%, which is what happened from 2020 to early 2022, that borrowing cost is now 6.5% to 8% on fixed rate loans on stabilized real estate. Now, what's happened because of that is cap rates have expanded a little bit on the whole, but not nearly as much as they should, because there is a correlation between cap rates and interest rates. Obviously, if you look back in the annals of real estate investing, generally speaking, commercial real estate has always had positive leverage available. That is, the cost to borrow is less than the cost of the cap rate you're acquiring at. So it can enhance your cash on cash returns. Why would you take equity risk for a cap rate that is lower than the cost to borrow? Now, because a lot of the sellers in the market have not adjusted their pricing where positive leverage can still be achieved, you have seen investment volume fall off a cliff, basically. It's down over 80% from the peak in Q4 of 2021. And there is still a lot of money out there. There's still a currency hangover in this market where the M1 and M2 money supply is near an all-time high. There's a lot of investors out there waiting for deals. There are still some investors that are out there doing deals with negative leverage. Maybe you've seen a few of them. It's something we strongly do not suggest in. It's pretty much investing 101. If you're looking for a risk-adjusted return, the speculation in investing in negative leverage deals is extremely high. So with this, we have seen, however, a number of sellers that are market sellers and have been able to present opportunities to us where the cap rate is 2, 3, even 400 basis points wide of our borrowing cost. And that has always been a fundamental part of how Sentinel invests, using leverage strategically in the market. So we do see selective opportunities here. If we were a $1 trillion PE fund, I wouldn't know what to do with the money. There's not enough deals out there that make sense. But because Sentinel is only raising a $100 million fund, we can really be highly selective and pick and choose what we think are good deals in this market. We're going to talk a little bit more about the effect of these elevated cap rates too, and what they've done to values, because that's another important part of our investment strategy. Looking a little bit more about the market, the other side of this, of the high interest rates, is how it's affecting the existing commercial real estate market as it relates to refinancing and loan maturities. And so the chart you see here is basically looking at last year and this year and the next 2 years on how many hundreds of billions of dollars of commercial real estate loans are maturing by lender type. And so historically, the CMBS, the securitization market, was taking up a bigger and bigger chunk of the commercial real estate lending business. That reset a little bit during the great financial crisis. And especially post-COVID, banks started getting, especially regional banks, started getting heavily involved in loan originations. And so banks are now the majority lender for commercial real estate in the United States by a wide margin. And it's not big bulge bracket banks. It's banks with under a few $1 billion of assets that have pumped out this debt. Now, what's happened is in 2023, this was really the first year of what we called the maturity wall. Because of these higher interest rates, a lot of in a normal market, you refinance, it's great. Your interest rate is maybe what it was when you first bought the asset or refinanced the asset 5 or 10 years ago. But because of the huge run up in interest rates, a lot of borrowers right now are facing cash in equity situations for refinancing. And if they don't have a long-term stabilized plan in place, it becomes very problematic. So you see some borrowers starting to give the keys back to their buildings. Banks do not want this. And so in 2023 alone, almost half of all commercial real estate loans that were scheduled to mature last year got extended in some capacity. We're talking about over $200 billion of real estate in the US. And if that actually had come to fruition, you probably would have seen a steeper decline in values than what we have, and more of a level setting to the current interest rate environment. But what's happened is we've kicked that can down the road. And Fred, who's actually on the board of directors of a large regional bank, can speak to this a little bit. But what's happening is you're taking that 200 billion and you're hoping that in 2024 or 2025 interest rates come down and that you're going to be saved as a lender. Now, Fred, I don't think I think banks are starting to realize that maybe that's not going to happen the way they wanted to. So how are some of the banks starting to deal with this problem of not being able to refinance some of their assets?
Well, I think banks really focus on what their performing books look like, and then they have their watch list, and then they have their special assets, and banks exist to kind of leverage their deposits and leverage their assets on book. So to the extent a particular asset could be marked to market, which is really a problem what Dennis alludes to, because if you don't kick the can, if you don't extend that loan, that property may have to be sold, or the property may have to be revalued, or there may have to be an equity infusion of sorts, at which point that asset may not actually be performing. And so banks are very cautious right now as to tackling more systemic problems, whether that's execution issues with their particular borrowers or some external factors. They wholesale do not want to take everything in and have a crisis that it has some similarity to what occurred in 2007, 8, or 9. So they are systematically kicking the can down the road so that they don't have an issue with the regulators. They don't have an issue with the bank structure. That being said, the amount of assets that are creeping into watch lists and special assets is substantially growing, and they're particularly where I think, Dennis, you alluded to kind of that negative carry, where all of a sudden the returns or the interest rates are actually below the cost of funds. And banks are struggling with this issue because where a bank's cost of funds used to be 20 basis points or 30, 50, 60 basis points. As everyone knows, you can put your money in a bank today and get a money market rate at 5% or 5 point something. And if you're not getting 5% in a money market, you probably should. What occurs is the banks have to have a spread above their cost of funds or what they're paying out in money markets. So they don't have a choice but to reset their cost of funds to borrowers that used to be at 3 and 4% to 7%, give or take, or even higher. And as a result, you have this negative carry. So if you have someone in a, particularly in 2021, for example, where multifamily syndications were a big thing, and a lot of investors invested in assets that had 4% basis returns, well, those resets are going to go negative, and they're going negative. So it's a conundrum, and it's going to continue to kind of build. And I think that bank boards are now addressing this very tightly. And the first thing what's happening is that banks are looking at what they call CRE, which is just real estate loans, and they're saying, hey, we need to pull back from traditional real estate lending. So it's we're starting to see, and I think whether it's part this summer into the rest of the year, we're going to see a kind of a wholesale pullback out of the banking sector into real estate lending, because they need to reduce their books because they see what's coming. And this maturity wall, as Dennis alludes to, is a real serious matter for a lot of bridge assets and a lot of short-term thinking borrowers.
And I think that speaks to kind of what we're seeing overall. Number one, we think that provides us a great opportunity as pricing continues to get reset over the next couple of years, and we're able to acquire stabilized assets at historically high cap rates. And we'll talk about that a little more. But another part of this is you have a huge universe of real estate operators who are struggling with their existing portfolio. and how they're going to refinance that floating rate or even fixed term debt that's maturing over the next couple of years. So you have the borrower struggling on one hand. On the other hand, you have the lender struggling as well because they're dealing with these maturity wall issues. They have tightened their lending parameters so much. The average LTV went from close to 70% on commercial real estate to under 55%. And that may not seem like a lot, but that's a pretty drastic swing overall, especially when you consider the cost of those funds have more than doubled now over the last 2 years. The amount of non-recourse loans is shrinking by the day, and as Fred can attest, the number of active lenders has dwindled substantially. We have a pretty robust capital markets team, so we are going out and speaking to 150 or more lenders on every single acquisition we do. And we're talking about credit funds, banks, life cos, CMBS. We test the whole market to get the best execution. And it is remarkable how tight the banking community has got in terms of their ability to originate new debt, because they're dealing with this issue at hand. A little more market commentary maybe than what you folks wanted, but we wanted to share with you kind of how we're looking at this market, where we see the opportunity, and then looking at some of the other things driving what we think are the opportunity for the fund from a property perspective. So on the industrial sector, we're not going out there and buying a 1 million square foot distribution center that's owned by Amazon. Those are one of those types of assets that are just getting a little bit too much attention and getting overbid, selling at a substantial premium to replacement cost, being purchased in many situations with negative leverage. There's no doubt the macro play on that is great, but I'm not quite sure how you get to an IRR that makes sense when you're buying with negative leverage today, unless you're really thinking you're going to thread some magical needle. Same can be said with a lot of multifamily investments right now. Where we're finding opportunities in the industrial sector are not the Fortune 100 companies, distribution centers, rather the companies outside of that, many of which are still credit rated, have great financials, and have mission critical manufacturing and distribution centers, usually in the same building. It's really a corporate headquarters for U.S. manufacturing companies. A lot of these folks are looking to right size their balance sheets and looking at long-term sale leasebacks. And for those of you not familiar, that's where the company that operates in the building owns the building and will sell it to us and then lease it back on a long-term lease. So we are seeing dozens of opportunities from very well-heeled operating companies with great financials that would have higher margins in their business than just sitting on the real estate. So we're seeing a lot of opportunities there that are in the 15 to 20 year range, absolute net leases, meaning we have zero responsibilities. And those cap rates are in the mid 8s to low 9s in some situations on the industrial side. Typically, these are going to be in secondary and tertiary markets, but the overall utility of the building is second to none. It's how this company makes money, and we're still looking for good neighborhoods within all of those markets, which we'll get to in a second. On the retail side, what we really like, retail got beat up before COVID. Online e-commerce was already starting to displace a lot of brick and mortar. Retail has evolved where it's now a multimodal hub, right? The way you shop is different than it was 5 years ago. So when you go to a Target, you can walk in the store. They can bring it out to your car. You can go in and pick up stuff pre-ordered. And these retail stores serve as de facto distribution centers for a lot of these retail brands now. So the multi-utility of those buildings for successful retailers is very important. We primarily focus historically on standalone grocery, and we also will look at select big box anchored centers and grocery anchored centers as well. Those are across the spectrum of locations. We own a number of properties already in secondary and tertiary locations that have performed fabulously. And we continue to look in primary markets as well. Those are typically going to have a shorter weighted average lease term. You know, somewhere around 7 or 8 years is kind of the minimum we're looking for those properties. But again, cap rates north of 8, borrowing in the 6s makes sense. And saving what we think is actually the most interesting for last is our opinion on the opportunity in the office sector. So let me just be very blunt here. The baby has gotten thrown out with the bathwater when it comes to the office sector. Much like anything, nothing is all good, nothing is all bad. And so the way office has been treated is that all office is bad, no matter what it is, no matter what the utility is. And we're actually we're becoming the beneficiaries of that conventional wisdom, because frankly, it's in this data age, it's a lazy way to go about investing because so much information is available out there. So let me give you just a high level data point that might blow your mind. So in the first quarter of this year, looking at the last 12 months, the U.S. had negative absorption of 31 million square feet of office space. That sounds like a lot. And it is a lot. But you would probably be blown away to know that more than 20% of that came from just New York alone. Another 10% of that came from New Jersey. So we're talking about a third of the entire negative absorption happened literally in a 20-mile radius. And that's what gets missed in the headline. You look at San Francisco, it's another large percentage of that. And so I don't know where everyone here lives, but I can assure you people are going back to the office, not as much as they did before. But I can also assure you the executives want those butts in the seats more than ever. They are seeing the importance of collaboration, of culture building, of efficiency of people being in the office. And so if you look at the mantra of a lot of captains of industry, whether it's Jamie Dimon, Howard Schultz, Bob Iger, these people are driving smaller companies to make sure they get their people back in the office. Now, a lot of companies have already right-sized what their office space of the future looks like, at least in the short term. And that's important as well, because I think over the next couple of years, you're going to have right-sized the office sector. And you'll find that there are tens of millions of square feet of Class B and C properties that are in not great locations. The buildings aren't well kept, and those have been functionally obsolete for a few years now and shouldn't really be factored into the overall vacancy rate. What we're focused on is buildings that have super high utility and necessity, usually mission critical buildings such as our corporate headquarters. We're really only looking at Class A properties, so really the upper echelon of properties in any given market. We're buying those at a fraction of replacement cost, so we have a natural defensive barrier against new supply whenever that comes. And then we're really getting it from two ways. We have a lot of institutional sellers who have end of fund life or have reallocated funds to a different strategy. And then we have, similar to what we've seen on the industrial side, a lot of long-term sale leasebacks from privately held companies that are looking to improve their balance sheet and put that money to work in this environment. We can buy these properties in primary and secondary locations throughout the country. In a nutshell, and I'll go into this in a little more detail when I talk about the strategy itself, but we're able to buy office properties with decade-plus long leases at a cap rate that's 9, 10, 11, 12%. We can borrow in the 6s to 7s, produce a double-digit cash-on-cash return. Assuming the tenant pays their contractual lease, it's a full return of capital to our investors. You're not going to see that in other investment types. And one thing I would note here that's important, if you're looking at deals right now where the cash on cash is 3 or 4 or 5%, and is banking on some type of cap rate compression coming in the future, let me explain to you how it's not a great strategy to rely on speculation for the majority of your profit. So if you're going to look at those deals and you're going to believe that interest rates are going to compress at some point in the next handful of years, even 5 or 10 years, who knows? Why would you collect a 4 or 5% cash on cash return when you can collect a 9 or a 10 or 11? And let me tell you, when interest rates go down, all the cap rates compress in a very similar manner. So we get the same benefit as an apartment or an SFR owner does from that cap rate compression. I would argue we actually get a better one because we're actually using positive leverage where those investors today are using negative leverage. So they have to believe that going forward in the future, all investors are going to keep using negative leverage on these things, which is a pretty tall tale to believe. Looking at the location itself, I am sorry my voice is going here. I was hoping it would hold out longer, but the location is a critical part of this. We only invest in suburban locations. We are not big believers in downtowns right now. We think a lot of them are stuck in a doom loop of poor politics, high crime, low quality of living, poor education, just a big struggle of getting people to work, live, and play in those downtown areas. And really, the suburbs have become the cultural hubs. And so we're huge fans of suburbs. You will find that the suburbs are performing much, much better than the central business district practically everywhere across the country. And so we like that long-term play of the desirability of the suburban market. Okay, looking at our fund investment strategy. Sorry, Fred, I didn't know it would go. I'm sorry.
Take your time.
Basically, interest rates have gone up, cap rates have gone up, the ability to borrow has gone down, your leverage has gone down. The benefit for us as an investor is now we can buy at higher cap rates, at longer term lease duration, at a discount that is 20 to 45, 50% off of the historical highs. Because the higher leverage point or the higher interest rate cost, we can't produce quite the same cash on cash return. It's pretty close. But what we can do is get a much higher return of capital from lease income. And ultimately, we think we can still generate a high teens, if not better, IRR while taking less risk. And that's really what this game is about, is risk-adjusted return. How much magic do I have to pull out of my hat to make a dollar? In this situation, we've got that elevated cap rate. We've got a lower investment basis. Again, fractional replacement cost. We've got that longer lease duration and thus a better overall risk-adjusted return. We think we've got a 2 or 3 year window to acquire assets that kind of fit this criteria. If it's not fitting this criteria, we're not buying it. It's very simple.
So Dennis, I'll give you a 1 minute break from your voice.
Thank you.
Maybe that'll help you. I think just to emphasize the strong risk-adjusted return commentary, I think that's one of the most critical aspects of this conversation and what we built the company around. You can take pretty significant risk for a higher return, and we don't look at significant risk as being acceptable as a concept. We look at a higher levels of return, good yield, for what we believe is to be moderate risk and risk that we can analyze with our teams. We've set the company up with Dennis and Andrew and I, and then other professionals we brought in who have lots of experience in real estate in general. So a lot of funds are created by younger people than us who have different levels of experience and sometimes very little experience in markets where it was easy to raise money. So they were promoted to do that. We look at this business as an extension of our experiences, our critical thinking, and so that we don't take risk that we don't understand. Not to say there isn't risk, and not to say markets don't react certain ways that are counter to what we thought, but we have a lot of experience at Sentinel to understand directionally what we believe is the right things to do from a risk-adjusted perspective. And so one of the key mitigants to all of that was to look at all the deals we did as syndications, and we looked at every deal from a value proposition, but not every deal fits into the fund at this point. The fund's focus is to make sure, as again Dennis alluded earlier, to have one of the key aspects is duration. We want to make sure, and it's one of the arrows on this slide, is that we have very strong lease duration. I think the average is 8 years plus. And that really is very, very critical, because on a strong tenant, and a lot of our tenants are creditworthy and rated, so that we feel confident that that tenant will be in the building for as long as that lease term, let alone if they renew, which is a phenomenal thing as well. But that we get a significant return of investor capital, if not in some cases, and in some assets, 100%. So I think that from a risk-adjusted perspective, that is such a mitigant, and that if things go not the way we thought, we're able to really have lease duration kind of buoy the day. As well as we know that lease rates may depreciate in some markets, they may come in. And so our view is we want to make sure that the properties that we purchase are with tenants with lease rates that are not outside of what we think market really is. And it's interesting, and I think Dennis, you alluded to this, from kind of the lazy underwriting that people do, which the more we look at what other folks do, we see some of this, which is that a lot of buildings establish lease rates with tenants that are slightly higher because the tenants get free rent or they get free tenant improvement dollars, and therefore they often get some higher rent rates to adjust. And then those developers end up selling those buildings. We're very conscious of that fact, and we're very conscious not to make sure that that's an exposure for Sentinel and for our investors. So we won't actually purchase the building with significantly high lease rates to market. And if markets adjust from a mark to market on lease rates, that we somehow have a mismatched lease or tenant. And if that tenant was to leave at renewal, or in some scenario or at renewal, that we are able to release that building at the same, if not higher, lease rates because of how we go in. So those are, we talk about risk-adjusted returns. It's a very critical point, and there's a lot of detail around that point that we spend lots of time as a group here really talking through and making sure strategically that we're aligned. And the last thing I'll say is, given that we have perspectives from a fair amount of years of real estate experience between the three of us, we also have money in the deal too. We're not one of those sponsors who just says, hey, this is great, and then earns fees off of our deals. We are investors, and we have not just our own money in every single deal, but we have friends and family in all of our deals, and they have been for decades. So to us, we take other people's money extremely seriously, and in some cases more important than our own, because of our years of experience and our reputations that come with all that. So I wanted to give you a break, Dennis, for a minute, but also kind of drill into how we think about the risk-adjusted return, concept.
Yeah, much appreciated. That's a ton of great points. Thanks, Fred. And I'll move through some of these slides a little quicker because you can read this in the investment summary at your own leisure. Because a lot of this really goes to what we're talking about before, in terms of what we're really focusing on. It's mission critical real estate, usually top 150 metro areas in the suburbs. Generally speaking, we want absolute or triple net deals. That's where really a de minimis amount of responsibility is on us as the landlord. But we will look at double net and modified gross leases at times. From a lease term perspective, we're really, like Fred said, getting that security of lease income in place. When you have a lease term that's 8+ years, it really makes things a lot easier, especially if you know you're with a very strong, financially strong tenant, to be able to return the majority of that capital to the investors from the lease income alone, and then ultimately, reduce that risk over time. Now, our primary strategy is not to hold these things a decade plus. Generally speaking, we think when we see some level of cap rate compression in the realm of 150 to 200 basis points, we're probably a seller. Now, not every asset is the same, so we'll take it day by day as it comes to that. But generally speaking, even though the fund itself has some duration to it, that duration is really more for the security and flexibility of the investors to make sure we don't have to sell at the wrong time. I'll get into that in a minute. Our underwriting is really critical. Fred touched on this a ton, and we really have this 7-pronged analysis of every property we acquire. So, is it good real estate? Is it in a good location? Does the return profile make sense? What's the lease structure and duration? Is it an absolute net lease? How long is the lease? Are there termination outs? We look at credit risk. There are a lot of folks that are sophisticated real estate investors, but they actually do not know how to do proper financial analysis of non-real estate related companies. So if you're looking at a nutrition supplement company or a outboard motor manufacturer and you need to understand those financials, luckily we are classically trained in financial analysis to understand what does this balance sheet actually look like? What are the risks of this tenant actually defaulting? That is something that is missing in a lot of commercial real estate analysis today. Another thing that we've always done, but has been enhanced even further in post-COVID, is what's the actual utility of the building? What are they doing there? What is the physical occupancy? How often are people in this building? Does it look like they're going to need this building long term? And then lastly, what is the value proposition? How is the property positioned in the market? Are we buying below replacement cost? Why is it we think it's a good deal? And when we combine all of that underwriting together, it really delivers a best-in-class review process where we feel highly confident in every asset we acquire. And then you may ask, well, how do you find these deals? Any which way we can is the short answer, but data is really what drives us here. We subscribe to a number of large property databases that allows us to not only source deals from third parties, provide, but also conduct market level analysis to look at, okay, what does the inventory in a particular market have that could work for us? How many buildings are from 50 to 200,000 square feet? And of course, that database also allows us to market to potential owner operators to look at sale leasebacks as well. So this really allows us to get maximum coverage in the market. And even though we're looking at everything, we're buying almost nothing. That's the best way to put it. So it really is a needle in a haystack approach. If we didn't have, if we weren't so well equipped on the data analysis and technology front, there's no way we could look at as many deals as we do. But just to give you guys a little bit of perspective here, in our history, we've looked at over 13,000 deals, right? This is a massive number of properties that our team has reviewed. Of that, less than 20% make the cut to actually get any kind of further underwriting done. Of that, barely over 10% do we make an offer on. And as Fred will laughably tell you, we are pretty much never the highest bidder for anything we acquire. But we have a very good reputation for doing exactly what we say we'll do. So when the high bidder blows out, they come back to us and we're ready to perform. And so from 13,000 properties to the 19 properties we've acquired. I mean, that shows you a level of discipline that is just doesn't exist in today's market anymore. Looking at the target markets, we're in 12 states. Those are the light blue ones. We're targeting a lot of other states. This does not mean we're going to buy a property in all of these states. It means we're just actively looking for deals here. And by the way, occasionally we see deals outside of this. You know, I don't have Michigan highlighted. I don't have Mississippi highlighted. But if I see a great deal in that market, we'll take a look. We're just spending more time on the data analysis side on those states in red and blue. We use a massive database that gives us economic and demographic information for all of these metro areas, down to below the zip code level, down to literally the block level. And that helps us make better investment decisions to understand the quality of life as it relates to crime, education, you name it. And so we have to have our eyes wide open in this market because we're not sure where the next opportunity is going to come from. And that's a really important part going forward here, is having the flexibility to be nimble. You know, being in 12 states already has taught us a great lesson in terms of how to mobilize our team, respond to issues, create tenant relationships, and we're going to build on that infrastructure that Andrew has built with the operations team. Looking at our active pipeline, these deals are fairly representative of the type of deals we're trying to acquire, especially cemented further by the deals that are in negotiation now that you can see below that. But as it stands right now, we've got an office headquarters in Memphis with a privately held nutrition supplement company. It's a 10-year cap rate for 20-year term. We have poured over their financials. They're owned by a private equity firm. We like where their company's headed. The two fitness centers we're acquiring, standalone buildings in great markets, buying those probably 150 basis points wide of the general market right now. So we're buying those with equity, imputed equity on day one because we're buying them as a portfolio. The third one, office headquarters for iHeartMedia. iHeart is, this is their headquarters. They are one of the largest media companies in the United States. They absolutely over-levered themselves a few years ago. Their latest earnings were not what we anticipated and kind of bucked the trend of 5 quarters in a row that were very solid. In this situation, we're waiting to have a call with the CFO of the company. If we don't like what we hear and we don't feel that the viability of iHeart is strong enough, we'll blow out of that deal. And that's something that you should know about us. We don't fall in love with any piece of real estate. It's all about data and facts. And ultimately, as we get more information in the diligence process, it has had us walk away from quite a few deals over time because, as Fred said, we are risk averse when it comes to a lot of factors in buying commercial real estate. Now, iHeart has an amazing story in terms of their overall coverage, their diversity into podcasting beyond normal radio. But at the end of the day, we need to know the tenant's going to be there long term. And so the numbers on this deal are phenomenal, but only phenomenal if they stay around. And we do that level of diligence on every single property we acquire. Going back to the fitness centers, some of you may be like, well, fitness centers got hammered pretty hard during COVID. Absolutely, they did. It's very hard to make money when your business is closed. However, gyms have been open for quite a while now. They have right-sized their balance sheet. They've been operationally for a few years now. and Fitness International, the parent company, their credit rating has skyrocketed over the last few years to a B1. So they're moving in the right direction. These two buildings perform very well, and we feel very comfortable about those acquisitions. Looking at the in negotiation, again, just more characteristics. You'll see a good blend here of office, industrial, and retail. And I think that's what you're going to see in the fund overall. We see that we've got a great runway across all 3 asset types. Is our experience predominantly in office? Yes. But we have exposure to all 3 of these, and as all 3 of these asset types. And as the opportunities come up, we're gonna strike. We're not trying to be 80% office or 80% industrial. We're really just trying to find great deals. And so whatever the split of assets by type or location, it's going to happen the way it happens, because we don't control the flow of inventory into the market. But we're really starting to see a lot of interesting deals as sellers have realized that interest rates are going to be higher for longer. And if they are going to sell, they should sell with more lease term, not less. I'm going to quickly go over the fund terms and structure. Again, you can look at this on the investment summary. It's a $100 million fund. That's our target. The minimum fund size will be 10 million. We have commitments well in excess of that now. So I don't think the fund would be any smaller than probably 40 or 50 million at this point. We make our distributions quarterly. We use cost segregation for accelerated depreciation whenever it's applicable. And then we're not redeploying capital. So if we sell a building, cash flow is coming in, that's going back to you. The only exception to that is if we happen to close on a property all cash and then refinance it later, those funds would stay in the fund, but only on that initial financing, no refinancing of any type. All those funds are coming back. The fundraising period is a year and a half. Hopefully we come well inside of that. We have a 3-year period to buy with a 1-year extension option if conditions still merit buying and we haven't purchased all of the properties yet. And then the fund length itself is 7 years long with 3 1-year extensions. 2 of those are at our discretion. 1 of those is with our investor advisory committee. We don't want this to be an 11 or 12-year fund. I can assure you of that. No interest in that really at all, other than if the market dictates we need to hold it longer. We want to make intelligent decisions as investment managers to not sell at the wrong time. I feel very bad for a lot of my colleagues in the space right now that are having to sell their assets from existing legacy problems. Luckily, we're fortunate where we don't have to sell assets right now. And the ones that we are selling are or have sold have come from unsolicited bids at prices that generate pretty phenomenal returns, as you can see. Looking at the investor classes, if you invest more than $1 million with us, you're Class A. And if 100,000 or more, it's Class B. The differences are really just a higher preferred rate of return and a slightly better waterfall for the Class A investors. You can see the fee schedule below here. One other thing I wanted to comment on was what we tried to do to add to the fund to give maximum flexibility and enhance the fund for investors like you that maybe are used to investing in syndications. So number 1 is we offer these structured commitments where you can invest early and you can structure that investment over time. So if you think over the next 3 years, you're going to invest $1 million with us, great. We're going to treat you as a Class A investor as long as you honor that commitment. And because of that, we offer what are called subsequent closings. So we're not raising all $100 million up front and then buying it. We're going to do closings over time. And if you decide, hey, this is going great, love the way Sentinel is performing, you want to come in on the next closing and up your commitment to the fund, you can do that. That's not a feature that a lot of fund managers have. Lastly, we offer sidecar investments for investors above a certain level. And what that allows you to do, it gives you that flexibility you're used to on the syndication side, where maybe you really like a deal we're acquiring and you say, hey, Dennis, Laura, Fred, Andrew, I love this LA Fitness deal. I love whatever deal. Can I put 100,000 in just that deal on top of my fund commitment? As long as we have enough of investors doing that and you're a qualified investor, yes, you can invest in a sidecar. So you can become overweight in certain assets in particular, which gives you that flexibility you might be used to of picking and choosing on the syndication side. Just quickly about the fund benefits and what what we really like about what we're doing here. Number one, we're doing the fund because we think we have a thematic approach to investing right now, where even though the assets are different, the locations are different, uses are different, we're taking advantage of what's going on in the market right now. And that's giving you diversification across property types and states. And ultimately, I'm sure some of you are in some syndications that are very good and some that are very, very bad. By diversifying this, I think it provides a greater level of stability to the overall investment with Sentinel. It also provides us access to larger deals, where we're at the upper end of the middle market into the lower institutional range. Having access to cash gives us a competitive advantage where we don't necessarily have to be reliant on leverage. Being a cash buyer right now is a huge advantage because, as I mentioned, the lending market is very tough, and there's sellers are looking for certainty of execution. We've also got simplified tax reporting. There's just one Form K-1 at the federal level, and then we have accelerated depreciation that we use on practically every deal. And then, as Fred mentioned earlier, if you're looking for an alignment of interest, the buck stops with us. Not only are we committing a substantial amount of capital into this, up to $5 million of our own money, we also have structured this in a European waterfall, which means we are waiting until the fund is done to take our promote. So if you look at a lot of deals, especially US fund operators, it's not a European waterfall. They hit a home run on a single project, they're going to have that waterfall go into play for that single deal. Whereas we are waiting until the end of the entire fund, all the deals are sold, for us to partake in the back end. That's how much conviction we have in our approach right now to what we're doing. Is we are taking a much more conservative, investor-friendly approach to the waterfall system. So I think that's as good as it's going to get for what you're seeing out there from some of our peers. Lastly, I think you probably already know now, because Laura's great at explaining this. Anyone that commits capital by our first closing, which is scheduled for June 20th, gets special incentives, which include reduced fees on the fund management side, acquisition side, disposition side. You also get the full benefit of accelerated depreciation. That doesn't happen as you invest later on. And then there's also lower sidecar investment eligibility. So normally it's a $500,000 investment in the fund to participate in sidecars. For founding LPs, it is $250K. A little bit about us. You see us here. We've got a great team behind us as well, covering our bases on the analytics, on asset management, investor relations, and day-to-day operations. Everybody on the team has a substantial amount of experience in the real estate investment field. And I think if you talk to some of the existing private investor club members, they will tell you that we are extremely transparent, highly professional, and always responsive to anyone's needs or wants. Looking at our portfolio, this is the existing stabilized portfolio of Sentinel. We've got 17 properties across the country. 16 of those are within the stabilized portion, almost 1.6 million square feet. Really cool stuff when you look at the quality of the firms. 60% are credit rated or Fortune 500. 90% of them have an annual revenue over $1 billion. We are looking for good companies to occupy these buildings, or that are occupying these buildings. And you'll see on this roster of tenant a bunch of blue chip name brand companies that we're very proud to call our tenants. Looking at our performance, this is pretty self-explanatory, but I'll just give you a little detail here so you understand. The first chart here where it says actual net cash on cash return cumulative, that is the total amount of capital that's been returned to our. The acquisition date is just to the left. The next one is what that annualized figure is, and you can see a lot of double-digit cash on cash returns here. That's been very hard for a lot of folks in the sector to compete with. And then to the right of that is how much have we returned relative to what we projected? And you will see, save really just one property, we're 95% and above. And on that one property, just to be totally transparent, our third party consultant that did our property condition assessment didn't do a full assessment and missed two major items on the roof and HVAC system. Now, it's not something that we would have known at the time because we rely on those reports. Without going into detail, we are in litigation with the firm that provided those reports. We take our diligence very seriously. Unfortunately, we were failed by a consultant. They no longer work with us. But other than that, by and large, things have performed exactly as we thought. And looking at the two deals that we've completed, Schnucks Fresh Foods, which is a grocery store that we bought in Illinois. We acquired that property. It was a huge property, 160,000 square feet. Most grocery stores are 40 to 60,000 square feet. This used to be a regional, a store and regional distribution center for a grocery store that Schnucks had acquired. Schnucks is a privately held grocery store with about 120 stores in the Midwest. They bought that, bought the chain, absorbed this store, really had no use for the back 80,000 square feet of warehouse. So we were going to demise it, find a new tenant for that back space. Had a very interesting core plus strategy where we were collecting a very nice cash on cash return, and we're going to add value by demising that space. Well, we had a 1031 exchange buyer that came in and frankly just gave us the price that we thought we were going to achieve after doing all that heavy lifting. So we sold it early. There's a much longer conversation about working with DST exchanges and buyers. If you guys are invested in those, I'm happy to give you a little bit primer on the do's and don'ts. Any case, that's who bought the property. We were able to produce a great return to our investor in a very short period of time. So, a 1.6 multiple in less than 2 years was fabulous. Most recently, and this just goes to show you for people that say that you can't make a buck in the office sector right now, is the JP Morgan Chase Center we had in Springfield, Missouri. We acquired that at nearly an 8% cap rate with 6+ years of lease term remaining. We got super long-term debt at 3.5%. This was easily one of the nicest buildings in Springfield. And we bought it for less than $100 a square foot. Fast forward, JP Morgan decides they use a contractual opportunity to reduce their footprint by about 60,000 square feet. We actually knew they had the right to do that. So we went back to the seller and got nearly $2 million in escrow to cover our TI and leasing cost in the event they did that. So they did that. We got the money from the seller, and as we took that space out to lease, the nearby hospital, who we thought was the likely tenant, actually said, "You know what? We'll just buy the whole thing." We have 30 acres under contract to develop a new facility. If you're willing to sell this so far below replacement cost, it makes a lot more sense for us to retrofit your building than build a new one. It was a win-win. So again, less than a 2-year hold, generated a phenomenal 1.7 equity multiple for our investors. And again, millions of dollars of profit in a building. And we bought this in March of 2022, right as interest rates were going up. And we still got a good long-term rate in there, and we're able to execute. But this speaks volumes to what Fred alluded to earlier. When you buy the right property in the right location at the right price and understand all of the things that may happen or could happen, you're really starting to protect yourself and your investors' capital. Because we knew if JP Morgan stayed in the building, we were still going to get almost a full return of capital. And JP Morgan may end up staying in this building long term. The hospital just knows that they want that wing and that they can work with JP Morgan to eventually take over a bigger piece. It's not really our concern. Our concern was, are we buying the nicest building in that market at a great price with great cash flow? Yes, yes, yes. And the proof is in the pudding because we sold it and were able to generate a substantial profit for our investors. One deal in here that is not included is a property we have in Austin. It's a value add property. We bought that building with essentially vacant. There was a very short term lease remaining. We were going to renovate that entirely, put it out to lease. It would be a comedy of errors if it was actually funny. But what's happened on that project so far is that the city during COVID was a little disorganized. People weren't going into the actual office. They didn't even have a site plan for the building. We had to create a new site plan. It added a lot of delays to our project that were out of our control. The project was then vandalized, causing $1 million of damages, again, out of our control. And so now we've handled all that. We've got the building permit. We've got all the repairs fixed, and we're just selling the building. And that building is not reflective of really the larger Sentinel strategy. It's certainly not consistent at all with what we're doing in the fund. In the fund, nothing we're acquiring is going to be occupied by less than, 7-8 years at a minimum, usually much more than that. Fred, if you want to chime in, my voice is dying, so I need a 10 seconds.
Yeah, I think Dennis's point is it's an asset that in Austin, Texas, given as COVID was unfolding and Austin was a strong market, we thought it was a value play. Didn't work out as well. We're going to endeavor to sell the building, but I think the point is it's not a type of an approach for the fund anyway. I think we learn a number of things from a value-added perspective, but every asset that we're looking at to acquire is stabilized day one with duration. So Dennison, being full disclosure, just wanted to state that asset isn't in some of the performance numbers because it's not systemic to what really the business model is, nor is it stabilized. But
yeah, nor has it ever had actual income. That was not
right
part of it. So thanks, Fred. Okay, so wrapping up here, I'd like Andrew to chime in for a minute here about kind of the standard that we're really trying to push out to not only the industry but our investors as a whole, in terms of how we're trying to provide not only a best-in-class investor experience for you, but also what we're doing on the asset and property side of things, and really just showing the universe of retail investors that you can in fact invest with a firm that treats you like you are an institutional investor. And so, Andrew, if you can just walk through a little bit about what we're doing for the Appfolio platform and our asset management and everything else.
Yeah, thanks, Dennis. So a couple of things. We've obviously come a long way in the last few years in terms of technology and the way we approach all of our assets and the technology we use. One of the things which you guys have probably seen a little bit is the use of Appfolio or an investment platform. And we're constantly monitoring and looking at the best way in which we can communicate with our investors. And that's kind of key for us, is to be able to look at each of our assets, understand of each of our assets, and then communicate the performance of that asset in a way in which is easily accessible via a portal, or even by phone from us, Laura, myself, or any of us, to be able to walk through the metrics of what you have, or the investment that you have. So a few things that we have put in place is obviously accounting is important. So when we started, we were sort of small. We had one or two assets, 3 assets, and it was building. And now we have over 20 assets to sort of look at, and we have an accounting system which can look at that on a global basis. And that's that's been key for us to understand how all the numbers work and how all of the numbers work together. So we can look at each asset very quickly and easily and identify issues. And we work with our property managers to get that information to us as well. So one of the things which, if any of current investors with us, we've moved, we've really worked with our property managers to do a lot of our sort of not only is the property asset reports, but also financial reports at the property level, and then we review that early in the month, and then we bring that into our own system as well. So it's a double sort of review, if you like, of the performance of those assets, and that's been a real key part in making sure that we're on top of what's going on, that we are understanding what the numbers look like. Third aspect of that is site visits and property manager discussions. So we just don't, even though a lot of people think we are a triple net and there's what could go possibly wrong. We just clip an income every month. That's not quite the case. We have a lot going on at each of the properties. Every month, myself, my team, Ben Black, who's our senior asset manager, he speaks to each of the property managers on a regular basis, and there's a set call, and anything that happens in between. So it's not just necessarily once a month, but it could be more than that. And we speak to them about who's in the property, what's going on in the property. Is there any issues that's happened? What's happening in the market? Really keeping on top of what we're doing and what those tenants are doing as well. And the third aspect of that is really going to visit the property on an annual basis, and that's we've done a few of those already this year, and I've got another trip planned next week for another couple more properties. And we just learn so much about the area every year. We speak to brokers, we have broker tours, so we probably speak to 5 or 10 brokers before we go out, and then they take us on a tour, and we get to visualize where everything is, what the tenant's doing, what the competition's doing. So when lease renewals come up, as they do, and as they're coming up now on some properties, we're really well prepared in terms of understanding what the market is in terms of those renewals, understanding the metrics, understanding what our negotiation position is in that, and not falling flat-footed when that conversation comes around. So it's really important that we're proactive, we really understand what's going on with the asset, and speaking to our property managers and brokers in the area all the time. So it's just a quick snapshot of the asset management side. Technology, interaction, and understanding is probably the key words there.
Thanks, Andrew. And it should be noted, the industry has agreed that we've built a best-in-class platform here, as we've been honored by several different publications for not only our investing prowess, but also the platform as well. I would be remiss to not mention that we also have a best-in-class team of third-party service providers, including great law firms, accountants, banks, property managers, and of course, technology, as we've mentioned, that really just round out everything. So even though the team internally is not huge, it's intentional in that regard, where we know that a lot of these companies have scaled and can provide best-in-class service to us and allow us to scale faster and more efficiently without disrupting the internal culture too much. And kind of rounding things out here, I know a lot of you have already invested. I've already mentioned this for accredited investors. From an investor relations standpoint, we have a dedicated investor portal. You have 24/7 access. Everything gets uploaded there, including your tax documents, your quarterly reports. We put out annual reports. We do ad hoc announcements. You can also access this on your phone. We also communicate with our investors via text message using a system called Project Broadcast. So I mean this in the best way possible. If you don't know about something going on with the portfolio or the fund, it is probably because you didn't check your email or your phone, not because we didn't communicate it. That's a good thing to hang your hat on. And beyond that, of course, we do like to communicate with our investors two ways. So we have lots of webinars like this, conference calls, in-person investor meetings. You can get one-on-ones with any of us anytime you want. And then we also have cool investor appreciation events throughout the year in select locations as well. So, this is a relationship long-term. Your money's great. We appreciate your interest, but at the end of the day, we're trying to forge good relationships with our investors and build trust and transparency along the way. All right, rounding third base here. So how do you invest with us? If you haven't already done this, it's pretty simple. You can schedule a one-on-one meeting with Laura or myself. You sign the indication of interest form. That's essentially a soft commitment to the fund. We use a third-party service to verify you as an accredited investor. Once that's done, you review and sign the offering docs. Actually, let me ask Andrew or Laura if that's correct. Do they get their verification afterwards?
Let me jump in here. You can actually, we have already got documents out at the moment. So if there is an interest, you can jump straight into your indication and we will send out documents immediately. After documents are signed, we will then send out the accredited investor. There's a portal that we're using there's a third-party verification service that you will sign up to, and it's very quick and easy. The easiest way to do that, by the way, is using one of your CPA or a broker to sign that you are an accredited investor. That's the easiest way to do it, and we've got letters to standard letters that you can use to do that. But we're really looking to, because our first closing is actually on the 20th of June for the first deal, we're making a capital call a little earlier. So we would need indications in the next couple of weeks. So we'll just sort of make sure that timeline is sort of compressed a little bit.
Yeah, thank you, Andrew. And with that, that's the end of the presentation. Just a brief hour and 10 minutes, only 30 minutes longer. I blame my hoarse voice, but hopefully we covered a lot of information for you folks here, possibly too much. Are there questions? What is the next step here?
Yeah, no problem. Thanks, Dennis. There are a couple of questions. I just do want to confirm with the Private Investor Club, you guys have reached the Class A status, given that we did an aggregate for you all to reach. I also want to say thank you to John Lefebvre, who is our sponsor liaison for the Private Investor Club. He's been in several of our deals, and I know we have several other members that have been in previous deals as well. So thank you guys for your continued support. It's been a pleasure getting to meet and speak with most of you over the last couple of weeks. Just a couple of quick questions. I think, Andrew, I'll direct this one to you. Based on what we learned from the T-Mobile experience and our use of that firm that I would say misguided us on the replacement of the HVAC units, given that they were not considered for replacement during our hold period. What have we learned about using contractors, and how are we vetting, local contractors in the state to do the work that we are performing?
Yeah, good question. And thanks for asking next. I want to talk a little bit more about T-Mobile as well. First of all, we have done a lot of extensive work after that situation and really dig into the reports themselves. So we have looked at several vendors. We now use one in particular, Partners, which is a nationwide firm. And we actually do more work vetting them after each report as well. So we will go in and say, okay, so what were the HVAC situation? Give us the service records of that. Tell us what how old they are, when their useful life is. And so we're actually being much more proactive on the reports themselves and going to see the properties from not just from an acquisitions point, which Dennis and Fred do, but we are actually going from asset management point of view to go and see those properties and really dig in, speak to the facilities managers. And that's a key aspect actually, because facilities managers don't know what to say and what not to say during a sale. So they're very proud people who talk about their building. So we love hanging out with them because they'll tell you everything. So we've done that a lot where facility managers will talk the building and walk the building, just tell you all of good, bad, ugly, everything about what's going on. So that's the first thing. T-Mobile, it sounds like a bad news story, but it's actually a pretty good news story, in that we are now getting 6 brand new HVAC machines on that building. That building is performing extremely well, although the distributions don't show it right now. They are fully occupied. It is a mission critical property for T-Mobile. We've been working very closely with the tenant saying we cannot afford to have this HVAC go down. So please work with us. We've got a great relationship with them. They've just spent over $1 million on a new cafeteria there. We are very confident of a lease renewal. It is absolutely mission critical for them. And if we are saving a little bit on, we're not distributing as much right now, we'll certainly get that back in the back end when it comes to sale or lease release negotiation. So although that might sound bad right now, it's not necessarily a bad news story at all.
Yeah, great. And I think it's important to note that we're not withholding the full distribution. We've just withheld a portion of it. So investors are still seeing monthly distributions from that property, even with the HVAC units.
Still probably beats your average multifamily distribution.
It's true.
One other thing to add on that as well is the level of reports that Andrew and his team gets as well is also more robust now, where we actually have not only the primary consultant, but also third-party specialists going out there for specific systems, whether it's roofing or HVAC or structural, you name it.
Great. And one other question that came, and I know Fred is not one to count his chickens before they hatch, but there was a question related to, there seems to be some really good downside protection in the assets that we're looking to acquire and the low cost basis, and potentially rates come down. What do you think is a possible realistic potential upside in the returns? And I'll throw that to you, Dennis or Fred, on how you guys want to dance around that a little bit.
Fred's going to stare me down if I say too big of a number. Look, what's an example of when things go extremely right? Look at the 2 deals that we've sold, right? Like both of those deals produce net IRRs in the 30s. Is that typical? Absolutely not. Is it possible? Yes, because we've achieved it. It's certainly not something we would underwrite. I would tell you conservatively, if we have more cap rate compression than what we've underwritten, we actually do sensitivity analysis in every asset we acquire that will show you kind of a base case, what we think is kind of a worst case, and then the best case. And so you will see, even though this is at a fund level, we do the sensitivity analysis on a deal level with each pro forma. You'll see that the IRRs can go from the worst case scenario, kind of upper single digits, low double digits, to best case scenario can easily be in the mid 20s, if not better. We don't want to bank on that. One thing that we think is a foolish task that a lot of folks are doing is that we think we can predict exactly what's going to happen. So that's why we do this sensitivity, because we don't know. And if that realm of possibilities on average produces what we think is a good risk adjusted return, then we'll jump on that opportunity. But we don't know what's going to happen any more than I don't even think Powell knows what's going to happen right now. So we're just trying to buy good assets at the right price with what we think is above average cash on cash returns.
Well, I think it's smart to consider longer term rates, rates higher for longer, thesis. And we certainly try to have buildings with duration that are 7, 8, 9, 10 years and longer, so that you're going to get through a cycle or two of interest rates. But assuming if interest rates stay higher for longer, you're going to see that only happens when you have systemic inflation. for a longer period of time. And so replacement costs become a factor. So you pick up value in that it costs more to replace the building, and it's more attractive over a long period of time. You may not see that in the current day economics, but you see that over a long period of time. If interest rates come in a cycle, then we'll position the property to refinance it at a lower cost of funds, at which point our yields will go up modestly or substantially. But we're certainly not going to model that in. Why? Because culturally we have an issue with doing that. We don't want to promise anything that we can't fully predict ourselves. And we're just culturally not those kind of guys. So I think you stress test and you plan for the downside, every scenario in the downside and what that can mean. And you consider the upside and you position for the upside. And if you achieve it, you achieve it. But you don't report that's going to happen.
Great, thank you. One other quick question going back to T-Mobile and the reduced distributions. It was a question about Grocery 3, which is the Schnucks where we got the longer extension term, and then also did the parking lot and extension in exchange for that 10 years. And Dennis, maybe I'll let you talk a little bit about that why we did that and why that's prototypical in that type of asset class where you're getting longer term in exchange for cash payments and parking lot improvements or roof improvements, things like that.
Yeah, that's that is not a problem at all. These are happy stories. So that is Schnucks grocery another Schnucks grocery we own in Peoria, Illinois. We have a great relationship with their corporate real estate team. The lease was coming up on the Peoria. We bought that at I want to say like a 12.5 cap rate. There was 3 years of lease term remaining. The existing owner, all Schnucks wanted was to get the parking lot resurfaced, and they would extend. But the previous owner, for whatever reason, a little bit of a novice real estate investor, had inherited from her dad, didn't know or want to do that. So we bought it at a great price, got in, coordinated with the Schnucks team, got a 10-year lease extension. And as part of that, we restructured some of the lease terms, and then agreed to pay for the parking lot resurfacing. So because we had not reserved for that parking lot resurfacing in advance, it was technically their responsibility. So we thought we would just lower their rent as a concession, but they said, no, we don't want to come out of pocket. Will you guys pay for it? No problem. So we withheld part of our distributions on that for a little while. It should be noted with, I don't know if Andrew or Laura has it right now, but I think that property produces close
still
to 20%.
14.8% cash on cash.
What is
14.8% still, even with the withheld distributions.
Yeah, right. It's a cash cow. And so for us, getting those lease extensions always are going to require some type of concession, or almost always. So we thought it was just going to come from rent reduction, not actual capital infusion to the deal, but that's why we withheld distributions. Now we've burned off of those withholding, and it is chugging along cash on cash again. That will, if we sell that deal in the next year, we have a couple of people looking at it. Again, we don't want to really sell in this environment, but some numbers may be too good to pass up. That will easily be the most profitable deal in Sentinel's track record if we sell it at the numbers being proposed today.
And I think it's important too, the $250,000 that we gave to the tenant, we anticipate that they're going to use those to improve the interior of their store. And actually a visit that Andrew and I went to, we could already see that starting to happen with the flooring, putting in these robots that scan the inventory for them. So we've already seen them start to redeploy that into the property at their cost, even though it was a $250 cash payment from us. One more question, I think, if anybody else has anything, now is the time to put it in. We'll try to wrap this up. A little bit more detail, Dennis, on the tenant evaluation for, the credit. They're using iHeart, as an example. And I know you stated we're going to be speaking with the CFO to figure out what's going on there. But what are your underwriting criteria outside of just the financials, maybe operating history, getting, speaking to the senior management of the tenants?
Yeah, it's a multi-pronged underwriting approach when it comes to understanding the credit quality of the tenant. So obviously, if they're publicly traded, the financials are very easy to dig through and see what we like and don't like. In the case of iHeart, one of the things that we liked was they were actually using a lot of their free cash flow to buy their corporate debt at a discount and try to right-size their balance sheet, which we thought was a progressive move and typically not something you see from a company that's about to go under. We also saw that they were making headway into the podcast arena, and that was a fast-growing revenue sector in their business. What we don't like is that they missed their targets this last quarter. The stock price got absolutely bloodied up, and ultimately, when your market caps gets to a certain level, you really have to take a quick look and say, okay, are they going to get gobbled up by somebody else? Are they going BK? And you don't want those type of binary outcomes in a long-term net lease deal like this. So as we get more information, we'll decide whether or not we proceed. But really, what we're looking at beyond just the finances is understanding where do they fit in their industry? Are they a market leader? In the case of iHeartMedia, they reach 9 out of 10 people in America through all of their various broadcast mediums. They're the market leader by far. Did they take on too much debt? And are their operating costs too high? Yes, I think they're trying to fix that, and that will ultimately decide whether or not we stay in the deal. And then we're looking about the real estate itself, obviously, as well. If they do leave, do we like our basis? What are the chances of releasing? That's obviously away from the credit of the tenant itself. The credit of the tenant itself is understanding where they've been, where they're at today, and where they're likely going. And if we don't think that they're a sticky tenant because either they don't find utility in the real estate, or their finances aren't good, or some combination between, it's probably not a fit for us. It really needs to be mission critical. And so, so not only is it reviewing those financials, not only is it talking to the senior executive team at each of these companies, it's talking and doing research with the rest of the market. Who owns this company? Is it owned by a PE shop? Is it if it's publicly traded, who are the majority owners? Are they institutional? Are they companies that could infuse capital to keep this company alive if needed? It is a pretty laborious process to go through and check these boxes off, but it's certainly not, I've heard of them, we should buy that. It's very nuanced. It's a ton of data, a ton of conversations and anecdotal information to really come to the conclusion of whether or not we want to buy that piece of real estate based on the tenant quality.
Great. Thanks everybody for attending. It was a long session, but I think it was well warranted given the amount of interest that we have had from the Private Investor Club. I put my email in the Q&A section. If you have any follow-up questions, I'm happy to get a call with Dennis or Brad or Andrew as a follow-up. For those of you that have indicated that you're interested, just a couple of dates here for you guys to consider. If you're interested in setting up a portal, please email me and I will get you the invitation. We are potentially issuing our first capital call June 5th. So in order to get those early investor incentives, you'll need to have been committed by then because our first closing will be taking place June 20th, and we have 10 days to call for the capital. And once you do set up your investing entity in the portal, you'll need to reach out to me so I can make sure that you guys are marked for Class A status prior to you signing the document. So please feel free to reach out. I think there's been several chats on your forum, and I think my email is all throughout there. But again, happy to answer any other questions, happy to set up any portals this week and get everybody in. Again, thank you for your interest, and we look forward to having a successful partnership with you guys.
Thank you, Laura. Great job, and thank you to the Private Investor Club for you guys' interest and continued commitment with us. We really appreciate it and hope to continue to grow the relationship.
Thank you,
Thanks.
everybody.
Have a great day.